Welcome back, traders. Today we're going to study one of the most important concepts in ICT trading, fair value gaps, or FVGs. We will break this lesson into 4 parts. First, what a fair value gap actually is. Second, why the market creates them. Third, how to identify bullish and bearish FVGs on your chart. And finally, how to use them in real trading strategies, together with market structure and liquidity. So let's get started right here on TradingView. A fair value gap is an imbalance in price delivery. When price moves very aggressively, there are not enough buyers and sellers on both sides to trade every price level. On the chart, this looks like a 3-candle pattern. The middle candle is usually a strong, impulsive candle. It leaves a visible gap between the wick of the first candle and the wick of the third candle. That gap is the fair value gap. The market skipped that zone, and very often it will return to rebalance it later. The market is driven by order flow. When large institutions or smart money enter with heavy positions, price pushes strongly in one direction. This speed creates an imbalance. Think of it like this: if there are too many buyers and not enough sellers, the price jumps upward, skipping some levels. The missing orders are left behind as an FVG. Later, the market often comes back to fill that zone, because unfilled orders still exist in that area. Now let's compare bullish and bearish FVGs. A bullish FVG appears during a strong move upward. The gap forms below price, and later the market may retrace down into that gap before pushing higher again. A bearish FVG appears during a strong move downward. The gap forms above price, and later the market may retrace up into that gap before dropping lower again. Let me mark both examples here so you can see the difference clearly. Now let's talk about practical trading. How do we actually use these fair value gaps? Here's a simple step-by-step strategy. Identify market structure. Are we in an uptrend or a downtrend? Find the fair value gap in line with the trend. Bullish FVGs in uptrend, bearish FVGs in downtrend. Wait for price to retrace into the gap. Don't chase the move, be patient. Look for confirmation. This could be a rejection candle, a liquidity sweep, or a market structure shift inside the FVG. Set entry, stop loss, and target. Usually, stop loss goes beyond the FVG, and target can be recent highs, lows, or the next liquidity pool. By combining these steps, you can turn FVGs into a powerful entry model. The highest probability setups come when fair value gaps align with liquidity. For example, if you see equal highs above the market, and just below that there's a bearish FVG, it's a strong signal that once liquidity is taken, the market may return to that FVG to continue lower. This combination is extremely important in ICT trading. Always look at where liquidity pools are sitting, and then check if FVGs line up with them. A quick warning: not every gap will be filled, and not every FVG leads to a reversal. Some are ignored completely if the market is too strong. That's why you must always wait for confirmation and use stop losses. Risk management is key. To summarize today's lesson, a fair value gap is a 3-candle imbalance caused by aggressive price moves. The market often returns to rebalance these zones. Bullish FVGs form in up moves, bearish FVGs in down moves. The best trades happen when FVGs align with market structure and liquidity. That's it for today. If you found this helpful, make sure to practice marking FVGs on your charts in TradingView. Thanks for watching, and I'll see you in the next session.